Right. Let's also get you a sense of what's happening with the markets this morning. It's been a slightly mixed global handover. You saw the US futures up yesterday and everyone anticipated quite a rally in trade, but then the opposite happened and the Dow ended 100 points down. This was accompanied by a massive crack in metals. Gold slid 5% and silver 13%. So on the back of that, our market's definitely facing some headwind today, currently struggling to hold 11,300 at 11,278. Within that, though, there are pockets that are holding out this morning. The mid-cap, for instance, is up nearly 0.4% at 4,500 nearly. The auto index is also up over 1% at 7,718 odd. So auto and mid-cap seem to be doing okay. The bank index is under pressure today for sure. It's down 0.3%. Within that universe, the select winners for today are an SBI and Adani Ports on the back of a decent set of numbers ahead of expectations. Zeal, M&M and Ayesha Motors, and then on the losing end you have a Hindalco, Dr Reddys, BPCL, CIPLA and Wipro. So that was just a short market check. I think our experts are now ready. Kunal is ready and so is Gaurang. Good morning and welcome to the show, both of you. Kunal, coming to you first. So much has happened overnight and the situation took a sharp turn from what was happening yesterday in the afternoon at around 4:35 p.m. when the futures were all inching up and everything looked fine. So what's really transpired in the last 24 hours globally that's leading to a slight crack in our market today?
I think, Varun, I think the first and foremost thing which happened for our markets was what transpired across the globe, and especially what happened to gold and silver yesterday. That was one of the reasons why I believe that the Nifty and the Sensex both sort of took a bit of a knee-jerk reaction. There's a bit of a risk of trade which is happening into our markets, and I think that's going to be one important key thing to pan out to look out for. The other factor to watch out for is the put-call ratio. We've been indicating that since the last so many days and weeks that the put-call ratio has gone back into an elevated kind of territory, and I believe in that regards it's going to be very difficult for the markets to try and sustain those higher levels. But then nevertheless, I think today what you're seeing is a different mix of stocks and sectors which are doing extremely well, and many of these stocks and sectors have been completely contrarian, and they've been more of laggards in the last so many weeks and months. So look at stocks like PVR, Indigo, etc. They're doing pretty well for themselves today. So I think that generally happens when the market goes into a bit of a contrarian mode, and I think that's how the theme has been playing out. So there are two stocks which I want to highlight in terms of a buy trade. I think even at current levels, the first one is Tata Power. I've been very bullish on the stock earlier as well, and I still maintain the stance that the stock is going through a consolidation phase after a steady uptrend, and that should result into a breakout yet again on the upside. So Tata Power is a buy. Short-term targets to be kept at 56, stop loss at 49. And the second would be a buy on SBI. I think finally after after quite some time, you are now seeing PSU banking stocks trying to break out about their resistances. So SBI has finally managed to break out about that 197, 198 zone, which was a major resistance or a hurdle point. So now keeping that 198 point as a stop loss would suggest a buy on SBI as well, and expecting that if this move results into a short-term uptrend, it could touch that 210 plus level.
Okay, all right. Thanks for your picks. Gaurang, hi, morning. From a fundamental standpoint, and given that the majority of earnings have been delivered so far, how do you view the market? How should one ride this tide? Is it a temporary blip, or do you see some profit taking, some pain coming by in key stocks and key baskets?
Thank you, Karanya, and morning to all of you. So it is not long back when we were close to, correct me if I'm wrong, 7,600 or thereabouts on the Nifty spot and 25,800, 900 on the Sensex. And we are in the second week of August, and we are at 38,000 plus on the Sensex and 11,250 or thereabouts on the Nifty spot. So we have made substantial gain, Karanya, in the last couple of months. And some of these sectors and stocks have even become a little bit expensive. And what I would want to say is that this is a healthy correction in an otherwise uptrend market, positive market. I would not call it a bull market because that will be an over exaggeration. but we are in a healthy zone. And the reference that you made in terms of earnings, well, at least as a brokerage house, we could not flag off any red marks on the sectors. There may be certain stock-specific red ticks, but sectorially and overall, if you go to see earnings for this financial year, first quarter, has not been disappointing, if I can use that terminology. So this is a healthy market, this is a healthy correction. And what are we? We are just about, and in fact, even from the morning opening, if you actually go to see, we have recovered almost about what, 50% or so. So this is a healthy market, buy on dips. The only request to all your viewers and investors of ET now would be that if you're a long-term investor or a short-term trader or a medium-term trader, please be careful what you're buying. I think that's very, very important.
Okay, thanks for that. Gaurang, do you have any long-term bets as well where one can invest at the current juncture for the long haul?
Investment ideas from a long-term point of view, both are from the different sectors. First one is from the auto, and this one, I would say, is well placed rather in terms of taking the advantage of semi-urban and rural Indian economic stroke agri growth, and along with that you have a domestic push as well. I'm talking about M&M. You have sports utility vehicle, you have utility vehicle, you have light commercial vehicle, you have heavy commercial vehicles, you have tractors, agri equipment. So it's a great basket of products to offer from M&M. And from the lows that we have seen in the recent time that I just referred to a while back, I think the stock has recovered quite smartly. We are targeting somewhere close to about 780 on M&M, Mahindra and Mahindra, from a long-term point of view. And one more thing, Karanya, I think the government and the Honorable Union Minister, Mr. Nitin Gadkari, has referred to the scrappage policy one too many times. And I think it is time that this scrappage policy comes out. And if it does so with clarity, without any words being mixed here and there, then I think all commercial vehicle companies will do rather well. That includes M&M, Tata Motors, as well as Ashok Leyland. The second one is from the IT pack. This is a large cap IT company, HCL Tech. Stellar set of numbers over the last couple of quarters. And this quarter too, there was no holding back for this company. It has recovered quite smartly again. But we believe that there is more steam left on the earnings front, and that will reflect upon the share price on the upward move. 840 would be the target on HCL Tech from a long-term point of view.
Okay, great, Gaurang. Thanks for those picks. Let's now move on to our queries for this morning. We have quite a few. The first one is from Rohit Gupta of Mumbai, and he's bought 100 shares of SBI Life at the IPO price of 700 rupees per share. He'd like to know if he should book his profits now or continue to hold. So Kunal, let's bring you up on SBI Life first. What do you think is the best advice rather for Rohit?
On to your investments on SBI Life, but my only concern, because when I look at the three key stocks on the insurance space, whether it's HDFC Life, ICICI Pru, as well as SBI Life, there seems to be a tad bit of an underperformance for SBI Life purely in terms of price comparison. So at one point of time when HDFC Life is very close towards breaking its the all-time high or the previous swing high, which was on the monthly charts, and I believe SBI Life is underperforming those kind of highs by a margin of almost 15 to 20%. So there is this tad bit of underperformance for SBI as compared to many of these other stocks. But then insurance space overall has done exceedingly well. Look at the last 4-5 months of this price recovery. SBI Life itself, if I'm not wrong, was at 500, 520 levels in the month of March, in that correction of March, and from there on, the stock had jumped up to almost 900 plus. So it's been a very strong pullback for stocks like SBI Life, and that generally is very positive from the longer term trend. So maybe there could be a slight bit of underperformance with respect to the other peers, but then because the sector itself is doing extremely well, there should be a case that SBI Life could also move up higher from current levels. since you bought at 700ish levels, I believe you already have a decent enough of cushion, and you should hold on to it from a longer term view.
Okay, all right. What about you, Gaurang? SBI Life, good bet to perhaps stay put in, or should one look at other options within the insurance space or the financial space at large?
On all the three names, life insurance related listed entities, that is SBI Life, HDFC Life and ICICI Prudential Life. Having said that, we had, as a disclosure, we had a subscribed recommendation during the IPO for a long-term point of view. And the best part that this situation, which the entire world and all of us are going through, that is the situation of Chinese COVID-19 virus, is that it has taught most of us a lesson in terms of insuring yourself. And in India, as we all are aware, there are, compared to the large population we have, the number of insured population is very, very low. I think it will be lower single digit. I stand to be corrected if I'm wrong. So this is a great, and the best part, Karanya, is that now people have changed the way they used to think, and now they think about insuring oneself. So it has become a basic necessity that in case if something happens to you, at least your dependents and family members can fall back on some, financial support. Having said that, we remain extremely positive on SBI Life, and our targets would be closer to about 1150 to 1200. This I'm talking about 1.5 to 2 year plus.
Okay, all right. So that's the word coming in on SBI Life. Moving on then to our next query, which has come to us from Twitter. The viewer wants our experts' views on Yes Bank and sugar stocks from a trading point of view, and what is the policy update perspective as well, given the fact that we broke the story as well on ET Now about the government looking to hike sugar MSP. Moving on, Kunal, if you could come in on Yes Bank and sugar stocks, if you could take them one by one and give in your take.
For Yes Bank, I think probably just looking at it from a very short-term view, the stock is hitting a circuit. I think for last 4 or 5 days. I think if I'm not wrong, the stock was at 11.5 rupees, and now it's at 16 odd rupees. So I think it's a stock which is now hitting circuit. So it now become more or less like a penny stock, and it's difficult to try and give a view on such kind of a stock, at least from a very near-term perspective. Maybe from a longer-term view, probably the fundamentals etc. is quite positive. You can look at investing Yes Bank, but from a short-term view, I would refrain from giving a view on Yes Bank. On the second query which you have on the sugar space, I think there are a lot of sectors and themes which are looking quite positive. I think one of the primary stocks which I've been very bullish on is Balrampur Chini since the last couple of years as well. And the stock has shown some very strong and solid chart patterns on the longer term basis. So many of these sugar stocks had a fantastic run in the 2019's year, where the stocks more than doubled from their swing lows on the yearly basis, and now they've gone through a corrective phase. But I believe that many of these stocks have not come back to hit their 2017-18 lows, and these stocks have managed to maintain that higher low kind of a trajectory. So I think in that regards, these stocks can bounce back from here as well. And I believe, or from the sugar pack, I think Balrampur Chini is one of the strongest stock in that space. I would look at a medium to long term target, say over the next 1 to 2 years, of possibly a 180 to 200 range on Balrampur Chini.
All right, thanks for that, Kunal. Gaurang, unfortunately, we're going to have to cut the query short because we have to cut across to Ruchi Bhatia. So a big thank you to both of you for joining us this morning. But on to Ruchi's story, the government is likely to soon announce fresh measures, including a big ticket infrastructure projects and policy change, as part of the efforts to rebuild the economy, of course, and to make local industry more viable and competitive. Ruchi is with us now. Good morning, Ruchi. Welcome to the show. Could you walk us through what these changes really could be?
Hi, Varun. Good morning. So we're given to understand that as a part of the various announcements that the government is looking to make in the days to come, Prime Minister Narendra Modi tomorrow is going to address tax officials as well as taxpayers via a video conference. We're given to understand Finance Minister Nirmala Sitharaman, along with the Revenue Secretary, CBDT Chairman, and various tax commissioners of various areas and regimes will be present. The idea, of course, is to unveil a more tax-friendly regime. The government had recently announced that they will be allowing a harassment-free tax regime through an online and a more digitized, faceless assessment process, which is going to ease tax compliance significantly for taxpayers. We're given to understand that tomorrow's announcement is going to focus on a taxpayer charter. This was something that was announced in the union budget itself. Looks like the Prime Minister is going to unveil the tax charter tomorrow. The idea, as I said, is easier compliance for taxpayers and a harassment-free zone as well. Having said that, we're given to understand that this is just the first set of announcements that will be made tomorrow over the next couple of days and in the run-up to Independence Day. And remember, Prime Minister Narendra Modi every year makes a set of announcements on Independence Day as well, even though his address may not be from the ramparts of Red Fort this time around. But the buzz is rife that the government is going to announce some sort of an announcement for infrastructure sector. It could be a dedicated finance institution for higher infra funding, something that we're picking up. Besides that, the government has already said that they will be walking the talk on single window clearances, on providing easier enabling environment, land parcels as well for various investors. There is also a talk about digital health cards that will be provided for all citizens. So these are some of the announcements that we can expect in the days to come. But tomorrow's announcement that the Prime Minister is going to make with respect to a harassment-free tax regime is going to be an important one.
That definitely, if he's going to be touching upon all of these themes and all of these departments, it's going to be a big one to watch out for. Moving on then, given how things have played out overnight within the commodity space, especially the precious metals. We spoke to commodity guru Jim Rogers, who recommends investing in precious metals as gold and silver, according to him, will continue to maintain highs. He also talks about correction in dollar to remain during the time of uncertainty. Here's a slice of that conversation.
Gold and silver peaked in 2011. It went down for 8 years, went sideways for 8 years, started going up again last summer, summer of 2019, and it's going to go on for a long time. We have big cycles in everything, especially precious metals. And if you ask me, the world is coming to an end in many places. As you know, the U.S. has added huge debt. Many countries are printing staggering amounts of money. That has always led to a loss of confidence in paper money and governments. And peasants like me, they tell us not to buy gold and silver. They tell us that silver's crazy, but I'm a peasant. And all of us old peasants know in the end, gold and silver will help.
You raise a brick of gold and a piece of silver, or was it the other way around? It was a piece of gold and a brick of silver.
Well, silver is cheaper on a historic basis than gold. Gold is near its all-time high. Silver is still down over 50% from its all-time high. So on a historic basis, silver is cheaper. I had rather buy silver than gold right now. I will buy both when the time comes, but I will probably buy more silver than gold just because it's cheaper.
Jim, in your assessment, do you think for next 3 to 5 years or next 2 to 3 years, one should expect double-digit returns from metals and commodities, or it's a very tall order?
What you should do is watch ET. I don't know. I'm not any good at market timing. I do expect both of them to go up a lot in the next few years because everywhere in the world, countries, governments are debasing the currency. The Bank of Japan is printing unlimited, that's their word, unlimited amounts of money. The Europeans are saying they will print as much as they have to. You know what's happening in the US? Nearly everywhere is printing a lot of money. That has always, throughout history, led to people seeking protection in real assets. This is not an opinion. This is a simple historic fact. And as long as they're going to ruin currencies, some of us are going to protect ourselves in real assets. And gold is will make new highs again, but silver will too.
Jim, last time when we spoke to you, you also said that, look, it's a stupid idea, but I'm actually long dollar. The dollar has weakened significantly. Is your thesis still intact?
No, I still own U.S. dollars, still own a fair amount of U.S. dollars. The U.S. dollar is, terribly flawed currency. America's the largest debtor nation in the history of the world, and it's getting worse and worse every day. I mean, in Washington, they've gone nuts. But everybody else has gone nuts too. As I said, the Bank of Japan prints huge amounts of money every day. So they're all doing the wrong thing. At the moment, the dollar's having a correction. The dollar's been very strong in the last few months, as you know. Now it's
Okay, slipping into a break here. Plenty more when we come back. Stay tuned.
Hello and welcome back to Buy Now, Sell Now. I'm going to tell you guys about Adani Ports now a little bit. They just put out their numbers, and as you can look at the reaction on your screen to the stock price, if it's there, it seems to be holding out quite well. Now what actually happened was there was a decline in volumes which was offset by better than expected margins. So there was 27% decline in seaport volume and then cargo volumes as well. What happened though as a result of cost-saving initiatives, some currency benefits and a 2.5% price hike is that the margins came in better than expected. So your EBITDA standalone at 1,300 and your consolidated at 1,400 were down 23% YOY, but they still were far ahead of what the street was anticipating. Also the PAT at around 760 crores was down 30% YOY, but again because of the margin enhancement, that's also come in ahead of street expectations. So in one line you can simply say volume growth declined, which has been offset by improved profitability. On the back of that today you have notes coming in from CLSA where they reaffirm their stance on the stock. They like the discount it has. It trades at a 30 to 50% discount to some of its peers. So they really like that particular aspect about the company. And based on that, they have a target price of around 386 rupees per share. And they think it's a great buy for long term as well.
Well, that's the wrap on Adani Ports. But in today's session, we're expecting Ashok Leyland numbers to be delivered. It's definitely going to be a weak set, just reflecting the kind of weakness and pain that the entire CV space has been witnessing for the past many months now. And of course, April and May were a complete washout for the auto industry. And on back of that, we're expecting it to be a weak set for Ashok Leyland. Sales are seen at 550 crores. We're expecting a loss figure of close to 400 crores. EBITDA loss also likely this time around at 320 crores. Of course, a revenue drop is exactly going to mirror the kind of fall, the 90% drop that they've seen in the volumes. Realizations, however, we're expecting them to improve on the back of BS6-led price hike despite the higher share of LCVs. Now, this is a segment that has been growing well for other OEMs as well, and even Ashok Leyland has been betting on it for many quarters now. But it's mainly the realizations of the higher capacity trucks that's likely to improve. We are expecting the low revenues and the limited scope of fixed reduction for a company like Ashok Leyland to weigh in on the operating performance. Interest cost is also likely to increase sharply on back of increased debt levels. We would like to understand from the management how the current industry utilization levels are. What are they for Ashok Leyland? Demand, production, a supply chain scenario post the lockdown will be critical to watch out for. Update on MNHCV growth outlook for FY21 and scrappage policy related expectations also key to watch out for. Moving away from markets to commodity space, gold and silver prices fall for the second time in 3 days. What's leading to this correction? Mobina is here with an explainer. Mobina.
Well, that golden rally may have just come to a temporary pause because overnight we saw this rapid fall that came by in gold and silver prices. In fact, even right now in the US gold futures market, that's overnight trading, we have roughly around a 3% slump being seen in US gold futures. So that means that US gold futures are now down below the $1,900 per ounce mark. Silver as well has fallen, and back home on the MCX markets as well, gold and silver prices have fallen quite considerably below that 55 and 70 grand mark that we had witnessed last week. So just in the last 3 days, we've seen 2 days of decline come by in gold and silver markets. What are the reasons then that have brought about a correction in this golden rally, as we've called it since this in the year 2020, in the last 1 year as well? Well, firstly, I think the most interesting, point around this rally has been the way the dollar index has plummeted. This is something that has led to the dollar index, to gold prices rather, going to 2,000 and record high levels. However, now the dollar index has found some strength again. It's back at 93 odd. So that's one point to consider. But however, I think the overarching factor over here is also the fact that Russia claims to have found a coronavirus vaccine. We have China data as well that's extremely strong. So all of this is spurring risk on sentiment. And not to mention the way gold prices have rallied, you're obviously going to have some sellers perhaps that will enter the market for profit booking. So that could as well be an overwhelming factor. However, Jim Rogers did tell ET now that if people and if countries and economies are going to continue printing money and debasing their currencies, people are going to look for real assets to invest their money in to protect themselves. And that's really where gold and silver play a huge part. In fact, Jim Rogers has said that I continue to own gold and silver. This correction just gives me an opportunity to buy some more.
All right, Mobina, thanks. Gold and silver definitely took it on the chin overnight, and quite a sharp fall we've seen. But given that we've also seen a stupendous rally, it's not too alarming for investors. All right, switching gears a little bit though, the PSP index, that's the Public Sector Banking Index, has been ironically one of the best performing in the last month. It's up over 5% month to date. It was down over 40%, more than 40% YTD. So now it's come to around 40% YTD and still is the worst sector of the year. All stocks, however, this month are gaining. So it's the worst sector of the year. YTD it was down more than 40%. Now post this 5% rally we've seen month to date, it's now only 40% down YTD. The particular stocks we'd like to flag off to you from within this universe are Indian Bank, which has moved 13% this month, J&K Bank, which has moved 12% this month, Union Bank of India 9%, PNB 8%, and SBI, the largest, has moved also considerable 6% this month. So that's what's keeping that index fairly upbeat. Also, along the same lines, we caught up with Chetan Parekh and tried to understand if banks are out of the COVID gloom, given that the fundraising spree now seems to be concluded for the larger players at least, and that the moratorium figures are not that alarming, and that the RBI is now also allowing a one-time recast. Let's listen in.
I think banks it's got a very big margin of uncertainty in terms of what the earnings are going to be. Going forward in the immediate future. So there are going to be asset quality issues. We're not even sure whether the moratorium numbers fully reflect. Moratorium, once a moratorium ends, and even the moratorium percentage is probably, I don't think it's the right indicator. We will know when the moratorium period ends what really is the asset quality. Having said that, I would say some of the bigger banks have already done all the right things. Have gone ahead and taken huge provisions. They have raised capital. They have gone ahead and they have been very careful about their asset mix. Their underwriting track record so far has been excellent. This has been a shock. Furthermore, any sort of marginal asset mix changes that they are doing are towards the conservative end of the lending. So when the large banks are gaining deposits, these sort of times people would want to put deposits into them. Furthermore, you have, let's not forget the long-term story of India. We can, we can get worried about and bog down about the short term, but India has, on a macro front, India has one of the lowest external debt to GDP ratios. I think the government, India has always opened up. India has always done major reforms in a crisis, and that really remains. And the demographics, you look at all the plus points that were there maybe 8 months ago, they still exist. They are not changed. So I think if you look at banks and if you look at any sort of growth in any economy, financialization has to happen. It's a given, and you've seen that in other countries. Digital adoption will happen. This is a very young generation which is quite savvy with using guys like me don't know how to use it too well, but the young generation, they're total different kettle of fish. So I think that companies and then the PSUs, which I think there is going to be a challenge to adopt to the new way, fintechs, etc. It's going to be a new way of doing things. I'm not so sure that so there will be a space that will be vacated by market shares, which will be vacated by PSU banks, and I think therefore the runaway from well-run private banks is just immense. And COVID doesn't really, in fact, COVID doesn't actually give them additional tailwinds. There is a bump ahead, but I think that bump is just a bump.
Macros, Poonam is standing by to tell us the IIP trends for the months gone by. Poonam, tell us a bit more and tell us what to expect going forward.
Well, the IIP contraction has definitely narrowed in the month of June. If you look at the figures, June IIP has contracted 16.6%. This is versus a sharp contraction in the month of April as well as in the month of May. If we look at the sequential movement in the IIP, manufacturing capital goods as well as consumer durables have showing a sharp double-digit rebound. Consumer non-durables as well has seen a growth of nearly around 14% in IIP. But overall, on a YOY basis, yes, the IIP contraction does exist. However, we have definitely seen some amount of pace of improvement in the month of June. Having said that, economists like ICRA as well as CARE Ratings do expect the GDP for Q1 to contract as much as 20 to 25%. JP Morgan's Sajid Chinoy does mention that June IIP was better than expected. However, the rebound is coming on a much lower base. If you look at the seasonally adjusted IIP, it stands at nearly around 82% of the pre-COVID levels. However, he also believes that the high frequency indicators are showing some amount of plateauing in the month of July as well as August as virus cases in the country are rising, and hence we really need to watch out for how the high frequency indicators do shape up over the course of the next few months. Having said that, all eyes would be in terms of the CPI for the month of July. Well, CPI has stood over 6% in the past couple of months. Having said that, RBI has already maintained an accommodative stance and they would be watchful of the inflation figure.
All right, thank you for that, Poonam. And on that note, let's take a quick break here and buy now, sell now. Hello, welcome back to EAT Now's Buy Now, Sell Now. As Titan posted a week set of Q1 earnings, we spoke to the CFO, Subbu Subramaniam, where he talked about metals rally and whether demand will return to the pre-COVID levels or not. Let's listen in.
Market share gains that I'm sure we are getting, because from what we understand the street, I don't think other jewelers are doing or have recovered to the extent that we have recovered. So I think that's very clearly happening. As far as gold price itself is concerned, I think there are different aspects here. One is that I think, as I said earlier, the investment avenues for many people seem to be limited now. Stock markets, yes, they're going up and down, but not very, everybody is comfortable there. Debt markets yields are much lower. So, and with inflation, threat of inflation, etc., and gold prices going the way they are, it looks to be a decent asset class for many people. And therefore, there are higher investments in plain gold jewelry, for sure, that we are seeing here, despite the high prices. So people possibly are expecting higher prices in future. So we don't know. But that's something that we are seeing. The second thing is that, as we were saying earlier, also, our hypothesis is that most people spending as such has come down. People are more looking at spending on essentials today. A lot of the discretionary spends which otherwise were happening, which is essentially travel and going out and so on and so forth, that's come down substantially. And that may also have resulted in people having more savings, and which possibly is going back to gold. So I think it's a combination of these. We can't precisely say exactly how much each of them are contributing, but this is how we believe it's panning out. See, on the ineffective hedge part, frankly, the P&L impact of whether it's effective or ineffective should normally be neutral. Okay, therefore, all it matters is where it is being shown. If it's an effective hedge, if the same hedge had been effective, it gets netted off in the revenue. Whereas if it's ineffective, it's shown as a line item in the P&L account. That's why the other expenses, for example, have gone up. Okay, so typically, if nothing had happened, if rates had been, say, flattish, and there was still an ineffective hedge, it would not have impacted the PBT as such. Okay, so that's how this works. And we'll call out that number also so that people understand what what component of other expenses included this. Now, the issue is that having said this, we are, as we mentioned earlier, working on this war on waste program. We started this well before COVID. So we started this sometime in December as part of our planning exercise this year. Those savings are kicking in. We are getting a lot of that. Of course, beyond the war on waste program, there have also been cuts in employee compensation, etc. So those also are going to happen this year. So this is a year where we will have significant savings on costs. And hopefully a lot of the savings will also be sustainable, which will carry on to the next financial year and beyond. And to that extent, I think this is a great opportunity to relook at our costs entirely and get a stronger base so that our margins do start going up from next year when we expect normalcy to be there entirely.
Are you looking for ways to earn higher rental income from your property? Is your tenant asking for leniency in rent because of COVID? On the Money Show yesterday, we caught up with the chairman and CEO of CBRE to help us get tips for increasing rental income and deal with COVID issues. Listen in.
As far as the landlord is concerned, I think they should really, work with the occupiers, understand their challenges. At the same time, of course, we expect the occupiers to also know that the landlord needs the return, but they should try to reach an understanding, because the risk for a landlord when they let a tenant go is more. That by the time they get a new tenant, you lose a few months rental. Plus, you have to also, renegotiate the rent, and the probability of getting a new tenant in these markets are a bit more challenging than in a normal market. So really, a landlord should first and foremost try to hold back the tenant he has. And then they can structure it in many ways. So one is that, okay, these few months are tough. We can look at some rent abatement, but going forward, we want to get back to normal rents. So really, the landlord should be looking at what is his overall return is going to be in next 2 to 3 years' time. Because if you let a tenant go and you don't get somebody for 4 months, 5 months, that rental loss, if you calculate, then brings down your average rent anyways. If you have a residential, if you're talking about a residential property, you can use it for guest house, anything for residential purpose, of course, and mostly it's allowed. In some cases, I must say a colleague of mine, for example, gave his house fully furnished to someone because it provides them better flexibility to come in, and it does not cost as much incremental cost to do a residential fit out to a certain level. Of course, there's no limit to what you can do, but I'm talking about basics, and that does provide a person coming in a flexibility to move in. You can also, there is also co-living opportunities right now, and where you can give it out for or for student housing. So there are various opportunities for residential. Similarly, in commercial space, there are landlords who are tying up with co-working operators for space because that provides flexibility, and and then they can get a rental. Sometimes it's not a rental which is straight rental; it could be percentage of revenue what you're earning, but still there is at least some income instead of just keeping the property vacant.
All right. And switching gears a bit, here's an ET now exclusive with the unicorn Pine Labs from the fintech space. Sequoia Capital's Rajan Anand says that Indian fintech is still at the stage of a trailer and that the main move is yet to come. So how is Pine Labs doing that when every biggie from Amazon to Reliance Jio and Paytm has trained its guns on Pine Labs' customer base in SME traders and merchants? Here's an edited excerpt.
We feel very lucky for the space that we are in. We've stayed in a very simple part of the business which says if a consumer wants to make payments, he's going to use the Pine Labs services. And based on that, we today process about $30 billion of volumes every year. So quite happy in terms of the space that we are in.
So what have the last 3-4 months been like for Pine Labs? Are you a COVID winner?
I wish I could say that I'm a COVID winner, right? But I think there are many moving parts which actually come together. So what we have clearly seen is that a lot of offline stores are still shut. So when it comes to a Bangalore, a Bombay, a Chennai, we still have stores being shut. Footfalls are not coming back to the small stores. However, what has been really good for us is the fact that the consumers who have been coming to the stores, they are showing very high % of digital payment transactions. So what we have seen is the transaction value being almost about 30-35% higher than usual. Plus what we have seen is the percentage of digital payment transaction has gone almost to about 25% in the stores in which the consumer is coming to. However, in the balance, when I look at the month of June, I would say we were like 20% lower than the Jan-Feb number. July is a little bit more tighter. So July is looking like 25% lower than Jan-Feb. But the way I'm looking at it is once we are done with this pandemic, consumers would have clearly shifted towards digital payments. People want to stay away from cash. And at that point of time, we are going to come out as a resounding winner. So that's on the transaction side. We also are India's biggest installment payments provider when it comes to credit cards. So when a consumer can go to a Samsung, LG or an Apple store and buy using his or her card and convert those into 6, 9, 12 months installment payment product, that is being done on Pine Labs. Now there we are seeing a 25% growth over the numbers in Jan and Feb. So clearly we have come out much better on the installment payment side.
Now, Amrish, you understand fintech, you understand payments. You founded Citrus, which was then taken over by PayU. And what's really fascinating is that you became in charge of Pine Labs during the lockdown, right? During the month of May. It must have been a real test of your leadership and your entire experience.
I have to say it's been very, very interesting. So the first 2-3 months, luckily being in the payment and fintech space for many years, I took understand the business, speak to everybody, really try and figure out what the levers within the organization were. And I think that is really the good part. I think the last 1.5 months is getting back to execution. We have a tough job, right? In a way, we have the responsibility to bring the Indian economy back, and you've got to find a way to goad the team to go back into the field to bring the small trader back into the economy. And it's a very important role that we play. Now that has been very tough, because on one side you've got to be very careful about the employees and the health of the employees, but at the end of the day we've got a responsibility to bring the Indian economy back and pushing your teams to go out and work with the small businesses to get transactions going. So yes, absolutely, it's been very, very interesting, and especially in the last 1.5 to 2 months time, I found it very exciting speaking to almost 1,000 people who hit the field on a daily basis.
With that, we're timed out on this edition of Buy Now, Sell Now. So it's a goodbye from me and Varun. Thank you for tuning in.